In today's video, we're going to talk about everybody's favorite topic, real estate. Are we in a real estate bubble? Is it going to pop? When? Or is it just going to keep going to the moon like it has? You know, in the last 3 years, if any of you have been following real estate, you would know that real estate has gone up tremendously. Since the pandemic, it's gone up 44%. That's how much. So today we got to really hit this one on the head with the data, because there's plenty of data showing you where the real estate market's going to go. And I got some news for you. Yes, we are in a bubble. But the US is not the only one trying to figure out the real estate market. See, if we take a plane across the world and we land in China, China's got a little bit of a real estate problem going on. But on another topic, we're setting some records. That's right. Just like Babe Ruth in his home run hit, we're setting some major records, but they're not good records. That's right. The records we're setting are the highest credit card debt ever, the highest household debt ever, the highest mortgage debt ever, and the highest student loan debt ever. We got a 4-time batting average that we're crushing right now. All of that wrapped up with the largest wealth transfer in history. So as you can see, we're covering a lot of ground today, but that's the point. Stay tuned. My name's Chris Naugle, and this is What Now? What's Next? Let's talk about real estate specifically. Pre-pandemic, real estate was doing well. But after the pandemic, right till now, real estate prices have gone up 44%. Think about that, 44%. Most people's homes have appreciated that much. But what does that mean? Well, that means for those that have the houses, that's great, you got equity. But for those looking to buy a house, that's not so good. And then you got a little itty bitty problem, and that is called the Fed tackling inflation. In doing that, they're raising interest rates. You all know that. They've raised interest rates, I believe, 11 times, more than doubling interest. But what does that mean if you're trying to buy a house? Well, that means the price of that house just went way up. Because if you take it from pre-pandemic till now, mortgage prices have more than doubled. That's right. According to the averages, right now, a 30-year mortgage is going to run you about 7.31%.
Oh, Chris, what happened to those good interest rates when they were only 2 and 3%?
We were living in a fairy tale land. Those are gone, never to come back. So now that rates are above 7%, what does that mean? Well, that means that there's a lot of issues. Because now when people are looking to buy houses, and it is not sustainable, what is happening right now. So according to Goldman Sachs, the debt to income ratio is above 38%. And by their standard, that is unsustainable. But that's not the only news you got. You see, you got a lot of other things that we got to look at. We got to look at housing prices and how out of control it's really been. I just told you it went up 44%, but let's break down the numbers. Check this out. 2017 increased 7.1%. 2018, 5.5. 2019, 6.2. 29% increase in real estate prices. 2021, 18%. 2022, 10.2. And 2023, pay attention, 0.5% decrease. Are we heading back down the other side? That's the million-dollar question. You see, there's a lot of data saying that 2023, we're going to see an increase of over 7% in housing prices. But why? Well, it's because of demand, right? There's so many people that want to buy houses, but why is there so much demand? Have you ever actually looked at the reason for the demand? Because it's not because housing is so cheap. No, housing is at all-time highs. It's not because mortgages are super inexpensive. No, mortgages are over 7%. So why all this demand? Well, some of it is FOMO, the fear of missing out. Some of it is millennials wanting to buy houses for their new families. And some of it is simply because the government printed $5.1 trillion, or actually, let me redo that. $5.1 trillion. You all know how that works. But see, that's the problem. There's so much money that was printed into existence out of thin air that it made everybody feel rich. They got their checks. They actually paid down their debt. They actually saved some money during the pandemic, but now they got to spend that money. And even though prices are going higher, people want to still pay these ridiculous prices because they think it's still going to go higher. But what happens when it doesn't? What happens when the bubble bursts? Well, according to the Mortgage Bankers Association, this market right now is the most unaffordable housing market in history. Think about that. So if it's the most unaffordable housing market, if rates are high, why are so many people scrambling to buy a house? Well, it's because there's not a lot of houses. Think about it. You own a house. Your house has gone up 20 to 40% in value. So from that standpoint, selling it sort of makes sense because you get to take all that equity out. But then what? Well, then you got to move into a new house. Yes, and that new house is going to be way overpriced. Oh, and yes, your mortgage is going to probably go from 3 to 4% up to over 7%. So why would you ever sell your house? Most people are asking that same question. I bet you're asking that question. Therefore, it creates a little bit of a housing shortage. But new constructions are also seeing a decrease. You see, here's the data. 2.1 million units were being built in 2007, and today you're at 1.5 million units. So we're decreasing. So let's get to the data. According to Fred's economic data, in 2022, the median home price of a house was $479,000. But in 2023, second quarter, the median home price has fallen to $416,100. And I always say, what goes up must come down. Which gives me to the point where you should probably subscribe to this channel. And while you're at it, why don't you click that little alerts button that's up top and smash that alerts button? Because like I said, everything that goes up must come down, and eventually we got to decide what data we want to keep and what data we want to throw away. So let's get back into it. And a lot of people don't know this, but that right there is a $63,000 drop in less than 1 year. That's the largest median home price drop on record since it was ever tracked. So let's go to one more piece of info. I thought this one was really interesting. Check this out. The average sales price of houses in the US in 2022 Q4 was $553,600. That's just wacky. In 2023 Q2, it's $495,100. There's some other things we have to consider though. A lot of this could be location specific. So if we take a trip over to the West Coast, you will see some major problems. And there's this company called CoreLogic, and they're looked at as the leader in indicating where we're gonna go with home prices. That's what they do, they track trends. So when you really look at a report that they just put out, and we focus on just the top 5 real estate markets that are predicted to have a decrease, and a big one, in home prices, look at how many of these in Utah are looking at a 70% chance of decline. And you got a couple other places like Boise, Idaho, and Florida. No surprise that Florida prices are probably going to go down. I mean, anybody that lives in Florida thinks their prices are just going to go up, but unfortunately, the data shows different. And I know a lot of you watch the news and you look at the data and you hear Zillow. And Zillow's taking a very bullish stance on real estate prices, saying, oh, real estate's going to go up. They're looking at this year, predicting about 48 out of the nation's 200 largest housing markets will see a 7% increase over the next 12 months. Key word, folks, the next 12 months. Do you know that real estate is a lagging indicator? Which means contrary to what the stock market does, even if the stock market fell apart today, which it very well might, real estate is still going to continue to go up for at least 6 to 9 months. So when you're looking at the data, you have to look at how are you going to apply that in your life. So you got Zillow bullish, and then you got Warren Buffett taking large stakes in D.R. Horton's and other home builders out there, which is looking at it as a bullish. But here's the thing you got to say. If you today bought real estate, there's no denying you're buying high, and you're buying at a high interest rate. But if you're thinking, oh, I'm buying high, but the market's still going to go higher, again, like I said earlier, for how much longer is it going to keep going up? We're talking about 12 months. And last time I checked, when you buy real estate, you plan to hold it a lot longer than 12 months. So what happens when the 13th month happens, the 24th month, the 36th month, the 72nd month, and your property values decline? Now, if all of you are buying rentals and you're playing it solely for the rental game, because there's a lot of people building apartment buildings. Matter of fact, it's one of the leading reasons why home builders are building more houses. It's not single family houses, it's apartment buildings. So if you bought an apartment building, I hope you're buying it just for the rent. Because if you're buying it for appreciation, you're going to get slammed. You're not going to do well with that because the pricing is going to go down. And the Burr method, which we talk about all the time, if you buy a piece of real estate with the anticipation of refinancing it in a year or 2 years, you are taking a really risky bet that pricing is going to go up. It might go up for the next 12 months. So if you can refi in 12 months, maybe, just maybe, you'll be okay. That's if the bank will even lend to you, because the Fed doesn't want banks lending money to you, because the more you buy housing, the more people that spend money, the more inflation continues to go up or stay where it's at. You see, it's a double-edged sword here. So let me give you my take on this entire situation. You see, there's a lot of data here, too much data. So let me just break it down for you. Real estate will not continue to keep going up. I don't care what they say about demand. There's a couple things you need to understand. First off, remember those 4 home run hits, the records that we set? Well, let me just tell you about those. They're debt records, which are not good. It tells you that people are sustaining their standard of living by using debt, by using credit cards and home equity lines of credit and all sorts of other debts. That's how they're doing it, because they don't have any money, but they're still employed. You see, we got really low unemployment numbers, and that's changing too. So to summarize it all, check these records out. And we're gonna cover this in another video, but you got 17.1 trillion in household debt, record. 12 trillion in mortgage debt, record. 1.6 trillion in auto loans, big time record. Oh, and by the way, the deferral period of your student loans ends the end of September. That's right, so October, households finally have a new bill. Thank God you get to pay that student loan debt back. And that's another problem. All of this with rising interest rates, the average credit card debt is 20+% now. Why are we not going to continue? Because we can't afford to. The Fed doesn't want it to continue. The Fed wants to bring inflation to a target of 2%, which means they're tackling that employment number because everybody's employed right now, but as they keep going with the rate increases, the unwinding of the balance sheet, and all the things they're doing to slow this economy down, mark my words, in the next year or 2 years, we will be in a recession. No matter what the government says, because they keep rewriting what a recession is, we're probably already in one by technical measures. So tell me this, how can real estate continue to go up when it was largely due to government and the Fed printing $5.1 trillion and pumping money into the economy, keeping interest rates historically low, which created a massive inflation problem, driving pricing up or weakening your dollar, and you've got employment numbers, which are very favorable, which are changing because now unemployment is creeping up. So be very, very cautious looking at this. When you got people like Michael Burry, the one that The Big Short was written about, taking a $1.6 billion bet against the markets, but on the other side, you got the Oracle of Omaha betting that the markets will continue to go up. 2 different tales from 2 different people that have both got it wrong a couple times. Really, it's you that has to make the decision. It's you that has to look at all of this data and decide what fits your investment profile. But I will tell you, the markets will go, and so will real estate. So if your long-term bet is relying on your real estate going up in value, you more than likely will lose that bet. Let me retract that, because I should never bet against the Fed. So it's anyone's guess. But the chances and the probabilities of real estate going up are slim to none. So in conclusion, I think you can drive to one single solitary message. We can't continue. It is not sustainable. Rental prices on luxury apartments probably will come down. The lower end rentals probably will remain competitive. Banks are not wanting to lend. If any of you have been to the bank to try to get a mortgage or try to buy a new rental property, you are seeing the impact of what the Fed is trying to do. They don't want you to buy that property. They're making it very difficult. Less and less people fit that little debt to income box. So there's a lot of headwinds. And I think when you look at the headwinds, you really need to make a very cautious decision about the future. That cautious decision should really be heavily grounded in preservation of principle. In other words, if you have money and you want that money to work for you, preservation of principle is one of the most important things, which, shameless plug here, That's why you should look into specially designed whole life. We talk about this all the time. It is one of the time-tested places where you can store wealth, earn a guaranteed return. And if designed properly, it's got tax advantages, potentially tax-free growth. And that money can be used to grow or be used to take advantage of future opportunities when the price of everything goes lower. You can save and spend at the same time without interrupting the compounding nature of your whole life policy. You see, that's what we teach, folks, the infinite banking concept, the process that goes along with the policy. And the process is the process of you taking back the banking functions in your life. So last time I'm gonna ask, we work really hard putting these videos together. All this data takes time and energy. So I wanna ask you for a little bit of your time to do one additional thing. Right down below, click that subscribe button, and while you're at it, there's a little bell. Smash that bell so you're alerted the next time we put a new video out. Folks, I hope you enjoyed this. I hope this information gives you the facts you needed to make the decisions for the future so that you are ready for what I think will be the biggest opportunity of all of our lives. This has been another episode of What Now? What's Next? See you next time. And if you want to learn more about the infinite banking concept and those specially designed whole lives, check this video out right here, BYO Bank, to teach you all about how you can be your own bank. See you next time.